Fundamentals of investments. Thank you very much for coming. My name is Dr. John Nyamunda. And today we are going to cover a few things. I don't know whether it's a few things or a lot of things. But depending on the speed we are going to cover, we have quite a number of things to cover. And so the first thing we're going to cover is going to be very useful in the long term because there's a chapter called Bond Valuation, 2 chapters. So we are going to start with it today. Not that chapter, but how to value a bond. It will be necessary, it will be important when we get to bond valuation to know how to value a bond. We are going to also just go through some of the things which you covered last week and then just refine and there's a poll coming your way. How often do you visit? I think there should be a pop-up which comes. How often do you visit my UNISA platform for INV2601? Okay. Now, if there's a pop-up which you see, choose there. If there's no pop-up, you can just type in the chat. Okay, let's see. Let's set myself up for success here by saying the chat is on and how often. Okay, that. Let's respond. Let's do this thing quickly, ladies and gentlemen. Let's do this thing quickly. Because remember, the easy things, we should need to do them quickly so that we have more time. Every time I'll end up the lecture without enough time. So let's do it quickly. Okay, we have 14 people and we have 5 responses. Let's get to 7. Ladies and gentlemen, let's get to 7. Then we can. I just want to know how often. How often? 1, 2, 3. 1, 2, 3, 4, 5, 6. Okay, no, we have lots of people now. 9 people. Some visit it weekly. Weekly. It looks like most of you visit weekly. My personal recommendation, if I was a student, I'm not. You see, it's always a challenge because sometimes we give recommendations because I post there almost every day or every day, every weekday. I say, okay, go there and look. Maybe it's enough to visit it weekly, but I think going there weekly daily might be worthwhile. That's my personal thoughts. It might be worthwhile to go there, but it's if you are going there weekly, I think it's decent. I think it's decent if you're going there weekly, it's decent. But daily or more than once a week might be useful because I'm always posting. INV, I'm always posting. As most of you know, we are always posting. And there was a question on this week where someone said, no, are you agreeing with the spreadsheet? Which was a brilliant question because there were 2 mistakes. And I went back, no response. I felt sorry for the poster. You are too dedicated. Some of us are still playing. Okay, let's go. Don't even listen to it. Yeah, working too hard. I don't know why it's not moving to the next. Okay. Oh, yes. Technology. Everything is on pause now. If you ask me why my laptop is paused, I would really want to also know.
It's too early for the computer as well.
It looks like who was having a bad day? I think they gave it to my laptop. Okay. And it closed. PowerPoint closed. And we are reopening it. And we are not going to be impatient with it. Otherwise, what choices do we have? Let's see if nothing else closed. And Kyle, can you still hear me?
Yeah, loud and clear.
Okay, yeah, there. So you are there seeing my joys.
It's the rebellion of the tech.
It always happens. It always. It's worse if you are trying to market something. Then it does this. How can the client buy now when the technology is letting me down?
Were you about to tell us a war in the Eurozone?
Yeah, that's what I was wanting to talk about. Then now, how can I talk about the war when maybe the Americans have seen that I was going to say something? Okay, let's see. I think the Americans will be happy that I'm using their platform, so they should allow me to talk about. Oh, not again. Why would it refuse to go to the next slide? You know what I would do? Since I wasn't born yesterday, I will go here on my secondary laptop and go here and download the same slides. Otherwise, we are going to have a terrible time here. Yeah. Let's try. Okay. Okay. Hopefully, now it is to allow me to do something. Okay, ladies and gentlemen, somebody said, actually, a US General Butler in 1935 said, war is a racket. It always has been. It is the only one in which the profits are reckoned in dollars and losses in lives. I was watching one video during this weekend. I said, wow, that's profound. She was, the lady was talking about the war in Ukraine. And you know why she was talking about the war in Ukraine? She was saying, look at these German companies. Okay, where is my point? My point at least should allow me to do something. Please, 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 please. Today I need to work. Okay. So these are German companies, 3 companies. This one is Rheinmetall, KMW, Hensoldt. Look at the share price from 2021. In 2021, I think it went up by 33%. And then the following year, look at what happened. More than 60%. And the following year, look at that, 30%, 50%. And in 2024, look at that. 60. So share price is more than quadrupled during these past 3 years because of war. So the point was, how can we end wars when companies are benefiting from it? And how can we stop people from starting wars when there's a big incentive to start a war? I said, wow, lady, you have a good point. But my point, ladies and gentlemen, okay, now my actual point is not that lady had a good point. My actual point is to say macro factors. Some of the things which we'll never talk about because we are going to focus on the calculations on the theories. Macro factors have a fundamental impact on valuation of assets in the market. You should not be like one of the ladies who used to call on me where I used to work many years ago. I said, it was during the presidents of President Jacob Zuma. I think it was 2009, 2010 there. So she called upon us and she's having a nice presentation. She's giving us forecasts, what's going to have to happen next year, blah, blah, blah. And I said, lady, nice presentation. I never heard you talk about President Zuma. What's your organization's opinion on President Zuma? Okay. Her comment never left me. She then said, we don't have an opinion on South African politics. Okay. I said, wow, lady. You cannot not have an opinion on politics because they have an impact on valuation of all asset classes. So whatever you're telling us is underpinned by the politics of the situation. And then the next following year, President Zuma fired the finance minister. Okay. Enough of that. Okay, today. Today we are going to talk about bonds. That's the first thing we are going to talk about. We are going to go back to the multi-stage discount model. We are going to talk about expected return, standard deviation. If we get to coefficient of variation, ladies and gentlemen, we are going to be celebrating. I'm going to look for my whiskey, take it out on the rocks. I won't do the Coke thing. If you are still doing whiskey in Coke, sorry for you, you don't know how to drink whiskey. So, okay, What is a bond? A bond is a contract where the borrower agrees. So it's a debt instrument. The borrower says, "I'll give me money, and in exchange, I'll pay you an interest every year. At maturity, I'm going to pay you back your money." Okay, so it actually looks like this. The cash flows. So the investment is like this. So you invest in a bond. In exchange, every year you are going to receive a coupon or an interest rate. Okay, every year or every 6 months. Every year or every 6 months, you are going to receive a small interest. And at maturity, what are you going to get? You are going to get the value which you invested. So if you invested here, if you invested here 1,000 rand, at maturity, you are going to get 1,000 rand. But because you have invested 1,000 rand every year or every half year, you are going to receive a coupon or an interest rate. So to find the value of this thing called a bond, we want to discount every cash flow. Now, we spoke about discounting last week. So you know, understand what discounting is. So we want to say discounting, we are saying, what is the value of coupon 1 today? What is the value of coupon 2, coupon 3, coupon 4, coupon 5? And what is the value of the last coupon and the maturity value? Using a discount rate called yield to maturity. If you can do that, then you can value a bond. So now we said, what is a bond? An investment which pays you a coupon, and at maturity pays you back the money. And to find the value of the bond, we are discounting all the cash flows of the bond. That's the fundamental thing about a bond. It's a debt instrument, it's an investment which gives you interest coupon. Okay. So now let's start with a question. We are already doing questions. Calculate the value of a bond whose annual coupon is 10%, matures in 3 years at the face value of 1,000 rand, and yield to maturity is 8%. So if we look at it carefully, we say value whose annual coupon is 10%. So 10% of what? 10% of 1,000, which is 100 rand. When is it maturing? In 3 years. So how often is it paying you interest? So it's paying you 100 rand every year for 3 years. Okay, so how does it look? So we are saying, what is the value of the bond today? If it's paying you 100 rand next year, 100 rand the following year, 100 rand the following year. And what are we using to discount? We are finding the present value of these cash flows for the period. So if we could to use our financial calculator, we say, what's our FV? Our future value is this number, 1,000 rand. Our PMT is our payment. To say, what is the coupon? What is the coupon? So it's 100 because it's 100, 100, 100. And what is our N? How long? What's the period? Our N is equal to 3 because it's 3 years. So what is our yield to maturity? The number we're going to use to discount is 8%. If you put all these numbers in your financial calculator, it's going to give you 1051.54. Then we're going to say it's a premium bond because its current value is more than the future value. Okay. You are going to forget this. I'm going to tell you one more little thing, because when we get to questions, we are going to get a bonus. Okay, I'm not going to tell you that. Let's play with this thing. This is your question. A zero coupon bond is a par value of 1,000 rand with a maturity of 20 years and yield to maturity of 8% compounded semi-annual. Calculate the present value. A zero coupon bond. What is the coupon? What coupon is it paying? What is the FV? What is the N? What is the YTM? Okay, let's do that. Let's do that while I'm fiddling with my other laptop. Okay, there's a hand up. I wasn't looking. I was doing like a good presenter, looking at my slides. Hey, let's see. Someone's hand is up. Please go.
Morning, sir.
Yes.
Can you please explain to me again? You said the present value is 1,051, and it's a premium value. Can you explain to me that premium part?
The premium part, we are saying currently, if you find the present value is 1051, but you at maturity are going to get 1,000. So we are saying it's a premium bond because the current value is more than the maturity value.
Okay.
Are you happy? No? Okay. Am I making sense?
Maybe,
Not are you happy? Are you happy is a bad question.
Yes. Okay. What you're saying makes sense. I think maybe it's just the word premium for me.
Oh, yeah.
Yeah. So you are saying the current value is less. I mean, sorry, the current value, the present value is more than what you will get.
Yes.
When the bond matures.
Yes. So it's a premium. There's a premium on your bond, which is a good thing.
Oh, okay. There's a on your. Okay, sorry. Thanks.
So if we develop that idea further, if this value is less than the maturity value, we call it a discount bond. Okay. Now the last thing which will confuse people. If this value is equal to the maturity value, we call it a par value bond. Okay, that's it. Please post in the chat if you have the answer. Okay, let's see. If you have the answer, please post it in the chat. If you are stuck, please raise your hand and let's talk. I don't see any hand raised, so I am busy doing some admin work in the background. Don't be shy to ask a question. Otherwise, then why did you come? You could have been doing something more exciting than coming to do this. Lebohang.
Hello, sir. How are you?
I'm good. How are you?
I'm all right. Sorry, I joined late. I just wanted to find out if it's zero coupon bond, because usually when I find my PMT, I would say times the
percent times the value.
Yes. So in this case, what do we multiply it by?
The zero coupon bond. It's not paying any coupon, any coupon.
So my PMT is 0.
Your PMT is 0.
All right. Thank you.
Would that not just make this a glorified savings account?
Yes. Exactly. It's a savings account. You're just holding money to maturity.
Thanks.
Why I use that question? Because most of the time, why I didn't use exactly the same question? Because in the exam, they might say a zero coupon bond. Then everyone say, oh, you never spoke about the zero coupon, which would be true. I would never have spoken about the zero coupon, but now I am speaking about it. Okay, Chantel says, Kyle, I'm writing exams with you. Okay. Kyle, how much are you charging for that?
We can fail together free of charge.
Ah, such a good man. I saw a business opportunity straight away.
I don't think I'm going to do any better than the next guy.
Okay, let's see. Let's see. 1, 2, 3, 4, 5, 6, 7, 8. Okay, ladies and gentlemen, let's go. Let's go. The answer is 208. Huh? How come people go to 214.55? Is it possible that is my mistake? Okay, let's go to Excel. Excel, please work. I don't have a financial calculator on the laptop which I can show you, so I'll go to Excel. And from experience, those ones, the apps, you know, those apps which we sometimes get in Android, sometimes they do all sorts of things. Okay, ladies and gentlemen, so we are going to. Sorry, because it's not exactly the same as what you see.
Sorry, because it's not exactly the same as what you see.
Okay, let's. Okay, I'm muting everyone else. Thank you. I was hearing myself twice. It's bad enough to hear myself once. Okay, so LV is equal to 1,000. PMT, ladies and gentlemen, PMT is equals to 0. N is equals to 40. Why 40? Because it's a semi-annual bond. A semi-annual bond pays twice in a year. So the period is going to pay for is not 20, it's 40. Okay? Then, so what do we want to do? So we have that. Then we have our I, which is the interest, is 8. But remember, 8 is annual. Then we are going to divide by 2, which will give us 4%. Okay, ladies and gentlemen, if I made it tricky, I am happy. So we are going to, okay, let me do the easy one, easy PV. We are going to find present value. On your calculator, it's easier than this. But I'll open my Excel calculator. So my Excel calculator makes it easy for me. Interest rate. So I will choose interest rate 4%. NPAR, number of payments, I'm going to choose the 40. PMT, I'm going to choose 0. Future values, I'm going to choose that. And I say, okay. Okay. You see? I know the mistake which you made. I'll copy this and paste it here. And I'll change one factor, which is 2 factors. We'll put 20 there, and I'll put 8 there. So that's what you got. Semi-annual pays twice a year. I'll agree. If you say you cheated, you showed us one example and gave us a question different. I agree. Okay, let's do this one too. This one is similar. Okay, same story. This is exactly what we did before. Future value 1,000. This is exactly the same question. The old question. PM2 is 100. N is goes to 3. Well, blah blah blah. Premium bond. Okay, now yours is this one, the red one. If now you feel like, okay, he cheated us this time, I'm going to do better. You can also do the bonus question here, which is slightly different, but now it also talks about annual mature. Yeah, it's now a semi-annual bond. The bonus question is a semi-annual bond. Let's go. Any questions? Okay, let's see. Shadow says, can we use Excel in exam? He said, Kyle asked that question last week. And my answer was, okay, let me be consistent. Kyle, if that wasn't my answer, then I'm changing. I think that was my answer. My answer was, make sure that you know how to use your financial calculator. Because this is an online exam. I don't know what the program will prevent you from doing. So sometimes the exam, the exam program will prevent you from using any other program on your laptop. So if you have mastered the Excel, you are going to be in trouble because you won't be able to open the Excel and now you are really stuck. So master the calculator. I'm using Excel because I don't have a financial calculator. I don't see the need for a financial calculator if we have a one which has been provided by Microsoft, which is called Excel. Okay. Same answer I gave Kyle last week.
Yep, it's deja vu.
Okay, cool. Ladies and gentlemen, if you are not sure, please raise your hand. I'm here. Okay, next one. Kyle has already done the first one. The next one. Let's go, ladies and gentlemen. Let's go. It's 26 past. Where did the time go? 26 minutes already. Oh, because I got all confused with that whole thing. If you are stuck, there are no prizes for being stuck, only prizes for asking and getting the answers right. Let's go, ladies and gentlemen. Let's go. Let me have some water while I'm waiting. Let's go. How many answers do I have? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. How many people do I have? I have 19, 20 people. I have lost some people.
There were some who said they were struggling to connect and had to reload and rejoin.
Yeah, hopefully they are rejoining using their browser, because I think the browser is more reliable. Okay, I'll give you 1 more minute so that we won't lose too much time with the 1 more minute. If we see 1/2 past, then we are continuing, ladies and gentlemen. Okay, I think a few more seconds. I am still 29 past. Let's see. When you say 9:30, we see 9:30, then we are continuing. If you have finished, please post. It's 9:30, ladies and gentlemen. It's 9:30. Let's go. Okay. 1075. Homoso got it right. Pilile got it right. Yeah, bonus question 17. No. Letamo 1075. Masha, that's correct for question number 1. Chandel, that's correct. Discount Kyle, I don't know what question was that. I think it was bonus question. Ellen, 1075, perfect. Lesecha, first question is right. The second one, I don't know what you were doing there. Then Lebohang, first question, perfect. Nompilo, first question, perfect. Should we do together or everyone is happy? Happy. Okay, let's do together. I'm feeling generous today, and I'm going to cry when we run out of time. I'm going to cry so much. Okay, but I'm going to cheat to make my life easy. Okay, first question, future value. We know it's 1,000. PMT, calculate the value of a bond whose annual coupon is 12%. So 12% is 120. Matures in 5 years, N is 5. And yield to maturity is 10%. 10%. Then here we are going to say, what is a PV? Life is good. Can we use Excel, sir? No. Excel is only for people who have finished schooling. And it's especially made for lazy people like me. What is the I rate is there, NPA is that, and PMT is that, FV is that. It's basically meant for lazy people. There we go, 1,002. Huh?
You
What
repeated.
mistake? What mistake?
You made a mistake in your formula there.
What mistake now?
The NPAR, you put 120 instead of 5.
I think it's a ghost from the Nyamundas. The Nyamundas don't know what The Nyamundas don't want me to. So this is your question. This is bonus question BQ. The Nyamundas don't want me to be successful. It's not even any strangers, all my people. Okay, let's put this one there. I don't know what it's doing. I don't know what it's doing. Or maybe I don't know what I'm doing. You know, they say it's fashionable to use the black background. I do the fashionable thing, but now look at it. I can't even see the way to hold. Okay, now bonus question. FV is there, 1,000. Ladies and gentlemen, I'm not going to say too many stories. Okay, now this is a semi-annual bond. So the coupon is supposed to be 8% of 1,000, which is 80 divided by 2, 40. Right? Okay. N is equals to, what's the N? 4 years, but it times 2, 8. The I, where is the I? Is 9. Divided by 2, 4.5. Okay, let's see. Let's see what happens. Okay, I wanted to be lazy, but no, okay, let me be. Laziness is not a virtue, actually. It's a bad thing. Okay, let's not promote laziness. Let's not promote. Yes. Right? Did anyone say anything? You are happy with the rounding up which happened there? Me too. But what can we do? We are using Excel. FV 1,000. 9. Because my YouTube maturity there is wrong. If we put 9 there, it will come up as 723.26. Okay. 927. Okay, but let's put 4.5. 967. Chantel, how would you get to 927? Chantel. Okay. Kyle, please talk to Chantel.
I used the wrong interest rate. It's this T. I told you it's this T. No one can function this time of the morning. It's T. I used the wrong interest rate. I used 4, not 4.5.
Oh, okay. Oh. Pilile, you got it right. 947, 967. Let's see. There's someone. Let me see. Ruvimbo. I think it's Ruvimbo. No, 166. I don't know what happened there.
So basically, I got the only thing that I didn't get right was the calculation for the PMT. Otherwise, I was on the right track.
Okay, that's good. Any questions, ladies and gentlemen? Because I think we are leaving bonds by themselves.
Someone's hand is up.
Hi, sir.
Yes, I'm
I
here.
don't know where I got my 166, but everything I got the feature value, it's 1,000. My the payment is 120,
Mm-hmm.
and it's 5. It's 10%, and I'm still getting 166 using my financial calculator. So I don't know where I'm going wrong.
The ancestors are unhappy. Okay, sorry. I need to be serious or change. So you said your FV is what?
It's 1,000. Everything that you have on your screen.
Go and clear your calculator. Go and clear your calculator before I give you another recommendation. Go and clear. Say, I don't know how to clear. I don't know what calculator I have. Chantel, I don't know what tea. You're having green tea without sugar. I think it's dangerous. That's poison. Okay. Letabo, your hand is up.
Yes, sir.
Yes.
I have the same problem as well. So, like, I was trying to enter the amounts again and clear the calculator. But the thing is, I don't know what's wrong with the calculator because it's...
the calculator?
Yes. I don't know. Should I start with FV or PMT? I don't know which one should I start with.
No, the order is not important. As long as the FV, there's 1,000 in FV, there's 14 PMT, 8 in N, In I, there's a 4.5. It should give you 967.02.
Oh. Okay, I'll try that.
Matsi. Bathsheba.
Hi.
Yes.
What is the N in this case? Is it 4 or is it 8?
The N is 8 because it's a semi-annual bond.
I'm also not getting you 723.26. Okay.
No, what are you getting? Are you getting the 9? Okay, 723.26 is the wrong there. That answer is wrong. Okay, let me fix that.
Okay. What is the correct answer?
967.
967.
What are you getting?
I'm getting 1230.86.
What is your I put your I 4.5 and they say give me the answer. Let's see what happens.
Okay,
Change
4.5
Hi, Matsi. Change your PMT to 8. I think you put it in as 40.
Let me see. 80, it's PMT, right?
Yeah.
4 point is the I.
PMT is 40.
Sorry?
Isn't the PMT is 40?
Is it 40?
Mm-hmm.
PMT.
PMT is 40.
PMT is 40. If you put it as 8, you'll get 1123086.
Okay, let me see if I get it right. 40 is the PMT, 4.5 is the I, 8 is the N. Oh, 96.
Why
okay.
are you
No.
so angry at your calculator? I can hear the buttons press.
Oh, that's also the reason why it was giving a wrong answer, I think.
Maybe it's the surface I'm putting it on. So I got it. Thanks.
Rumimbo, did you come right?
No, I didn't.
You didn't?
I don't know what's wrong with my calculator. I'm still getting the same answers.
Okay, I'll give you the last recommendation. This is a very serious recommendation. Is there a black bean somewhere near you?
Yes.
Okay, go and put it there. I think when it comes out of there, it will go to the right place. Okay, there's a pop-up which comes in. Okay, ladies and gentlemen, okay, let's take a small break from calculating. Why determine the slope of the security market line, SML? Okay, to cool down the engines, you have been in a high gear for too long. Let's put in the easy gear, like gear number 6. What determines the slope in the SML? SML being the security market. Now let's talk about theory. You can use the pop-up there, which comes up your poll, or you can go type in the chat. Let's go, ladies and gentlemen. This is the multiple choice. You can just choose anything, then we can move on. If you don't want your name to be seen, you can use the poll there. Choose the poll, and then off we go, so that we don't get stuck with theory. What determines the slope? Some of you will say, but you never taught us this thing. Yeah, that's what I do. So then we talk about it and then we move. Then we have learned something. As opposed to me talking throughout. Okay. Ladies and gentlemen, so the slope on the security market line is the market risk premium. Now you know this market risk premium. I don't have to give a long. I don't give a long lecture about the security market line because I don't have it drawn somewhere. Let's see. Do we have another question? Oh, okay. We have a video. Oh, ladies and gentlemen, we are showing a video. Life is good. I like the video. Okay, 3 minutes video. Hopefully I'll find it. If I don't find it, then I'll be so embarrassed. I won't be angry. I'll be just embarrassed a little bit. I think I said the audio play with sound. Play.
People have this reoccurring nightmare that there's some things, some force that's got a hold of them and it's holding them down and they can't break free. No matter what they do, they can't break free from that force. Well, I'm here to tell you that that thing in your nightmare, that thing that's holding you back, that thing that's dragging you down, that thing is you.
There are two fundamental attitudes toward life and its sorrows. Those with the first attitude blame the world. Those with the second ask what they could do differently. It's much easier and much more gratifying to your basest desires to blame someone else for your misery.
You know what's so funny? We want people to make guarantees to us, but we're not willing to make guarantees to ourselves. That's the problem with some of you. You always want to blame other people. You owe you an explanation. You need to look at yourself in the mirror and say, why are you only giving 50%? What's wrong with you? You need to put yourself on punishment. You need to tell you no more TV, no more snacks, no more desserts. No, we're working out now. You need to tell you that you owe you something.
Every day I demand more for myself than anybody else could humanly expect. I'm not competing with somebody else, I'm competing with what I'm capable of. My number one competition is me. It's always you versus you. You gotta be the one to get up every morning, be disciplined, put in the consistent daily hard work, because that gains success. No coach, no trainer, no mentor, no boss can do it. You versus you.
I value myself enough to give 120% or don't do it. There is no excuse for not living up to your fullest potential. No excuse. You walk out of this room, you owe yourself. I didn't get here making excuses. What changed? I changed. And I stopped being a victim. I stopped saying I gotta wait for good things to happen to me. And I said I'm gonna grind. I'm going to fight. I'm going to work. I'm going to press forward. I'm going to learn. I'm going to do everything in my power every single day to become a victor and not a victim. Why? Because I owe it to myself. Can't nobody stop me but me.
Okay. Okay. I always need to really to hear that from time to time. Always. Always need to hear that from time to time. Because when things get hard, like they are what they're about to do, I always find I'm not good enough. That's my default position. Okay, ladies and gentlemen, let's continue. You know that we did a two-stage discount model last week. Two-stage discount model. Somebody had a goat and then they put a goat. That's good. Okay, ladies and gentlemen. Okay, let me focus because now we need to focus. This thing is going to be difficult. So, but we got the pep talk. We are good enough. We are good enough. I have to hear that every time. Especially when I'm like there's something I'm doing during my spare time these days. It's challenging, man. It's challenging, but I am good enough. That's what I'm telling you. You're also good enough. Shande was you were watching while it's went. Okay. Ladies and gentlemen, multi-stage. Okay, we are back to something we did last week, but now we are taking one small step forward. A company, so we are still using the multi-stage. Remember last week we did two-stage discount model. Now we are doing a multi-stage discount model. So let's hear the question. A company ABC paid a dividend of 8 rand. Okay, let's write here. Let's write here while we are going D0. It paid what? 8 rand. Okay. During the last financial year, its dividends are expected to grow at a rate of 18% in year 1. Okay. So we are going to say year 1 here, year 1, and we are going to expect there will be a year 2, maybe somewhere. In year 1, it's going to grow at 15%. 18% in year 1, 18% in year 1, and in year 2, 15%, and in year 3, 10%. 10% in year 3. Okay? From year 4, the growth is going to, okay, so we are going to say year 4, then we put these 2 arrows. It's going to grow at a constant rate of 6%. That's just 6%. Taking it from the question. Taking it from the question. Ladies and gentlemen, from year 4 is going to grow, is expected to grow at 6% indefinitely. If investors is expected the required return is 10%, what is its intrinsic value? So we are going to put our expected return, skip a line there. Hey, it's too small. Why are you not complaining? You can complain. Complain. Yeah. Remember us, we are not youngsters anymore. You are 27, but we are not. That's what you're supposed to say. Okay? So the 27-year-old will understand. Okay, then we are going to skip a line there, and we are going to say our required return there is 10. I was so happy this week when somebody said, no, your calculations are wrong. Yes, that's what I want, because then it helps. So we are told that, so in year 1, so dividend now. So dividend, this is the actual dividend here. I was supposed to, okay, I don't want to confuse. Okay, so in year 1, the dividend is going to be that times 1 plus 18%. To just make my life miserable, okay? Put that, okay? So we have grown 8% by 8% by 18%. In year 2 is going to say equals to that new dividend times 1 plus that, and we are going to close the bracket so that our calculation works well, because there it might not have worked correctly here. Let's do this. Let's do this. Let's do this. Let's do this to make sure that we are doing fine. Yeah, it did that thing calculation was wrong. The initial calculation was wrong. So then we are going to say, then year 3 is going to grow by 10%. So we are going to grow the last dividend by, we open bracket, 1 plus that. From year 4, we are going to also calculate what is year 4 equals to that, so that we find the dividend in year 4 times 1 plus. Okay. Are we still together? Okay. So far, so good, I suppose. So far, so good. So far, so good. Okay. So this is dividend 1D1, D2, D3, because this is what we got from there. So now we have like opened up the question into numbers. So the next thing we want to do, if you are like me, forgetful, a little bit forgetful, the next thing you are going to do is to find the present values. So we're going to say, we are going to find the price, not present value, price in year number 3 there. So what is the price using the constant growth model? So we are going to say D4, let's put our price here so that we have enough space. D4 equals to this one, divided by, open brackets, required rate of return, this 10%, minus constant growth, this is the long-term growth, close bracket. So that 316 is the price in year 3 price. This is year 3 price. Okay. Now we have all the factors. Now what's left is to find our present values, PVs. Okay. So what is the present value of 944? We are going to say equals to 944 divided by, open bracket, 1 plus this required of rate of return 10%. Then what is the present value of the next following year? Equals to this dividend divided by 1 plus 10%, but because it's year 2, we are supposed to raise it to the power of 2. Same here, equals to this dividend divided by 1 plus, we're finding the present divided by that, because it's the third year to the power of 3. Then this is the price in year number 3. So we are also going to say equals to this price, the present value, divided by 1 plus 10%, close bracket, to the power of 3, because it's the year. Then we're going, what is the final price? The final price is only equals to sum. We are adding everything here. I'm open for questions, ladies and gentlemen. Questions? I like it. People are understanding. I like it. So you know
Dr.
what?
John,
Yes, yeah.
the first part I'm getting, but the second part where you're calculating the price and the PV, I'm a bit confused a bit there. If you don't mind going.
Yeah, this one, that's the one you're not happy with.
Price and also calculating the present values.
Okay. So the price there, okay, remember our constant growth model, says the price is equals to D1. That's a formula. D1 divided by required return minus G. That's the formula for finding the price of a share which grows at a constant rate. So when you are here in year number 3, we are saying, what is our D1? Our D1 is from here where it started to grow constantly, which is year number 4. That's where, so we used 1266 there, which is F3. 1266 divided by H2, which is this one, required return minus the growth, long-term growth. Making sense? I didn't see who was talking.
Yes.
Okay. Then the present value. To find the present value of any number, we are going to say equals to the future value, which is in this case, it's 1944 divided by 1 plus, this is just a formula, 1 plus the required return, which is 10%. That's for year number 1. For year number 2, we are saying this dividend divided by 1 plus the required return. But because the formula says to the power of n, because it's the second year, we say to the power of 2. We are going to do the same here. Dividend divided by 1 plus 1.1, 1 plus this required return to the power of 3, because it's the third year. We go and do the same to the price, this future price. We are going to say to the power of 3, this price, 1 plus 10% to the power of 3, because this is the price in year 3. It gives us that. Then we add up everything. Ladies and gentlemen, I'm not too stingy. So yours is this one at the bottom. And I'm going to zoom this a little bit. Okay. And I'm going to, okay, I think it's good enough. I'm not going to add anything to confuse people. Any more questions? Anyone with a question? The discovery dividend. Let's go for that one. Okay, let's see if there are any here. No, I don't think there are hands up. Let me have some more water. When you find your D1, can you please go to cell C3? Cell C3. So cell C3, we are growing the D1. We are growing, remember this one is D0. Actually, yeah, I was supposed to say D0. Okay, okay, I won't change the positions. You always have better ideas. Always have better ideas afterwards. I'll give you maybe 5 minutes. When we see 10:03, we are going to continue, ladies and gentlemen. If you have a question, post it in the chat. Post it in the chat, then we can deal with it. If you are struggling, because the biggest value you can get from attending is if you have a question you can ask, because then you can have a live answer. I'm not understanding this question. The first line is the stumbling block. Okay. Discovery paid a dividend of 6 rand per share during the last financial year. Its dividends are expected to grow. Okay, so it paid 6 rand. So this is your D0. Researcher, you can unmute yourself if you want, so that I understand where you're stuck.
Yeah, let me just keep trying and see what I come up with before I complain too much.
You're allowed to complain. It's good. It's good for your health. When you find your price, like this year 3 price, you can post it in the chat so that I can see at least who is close to the end. Okay, Letabo has an answer. Kyle has an answer. Year 3 price. Okay. Okay, ladies and gentlemen, half a minute. So when you see 4 past 10:04, we are continuing. Yeah, I'm just preparing. I'm just preparing my spreadsheet. I'm trying to think through. Okay, ladies and gentlemen, I can see a few. I know you are still fighting with it, but let's do together. Otherwise, we will run out of time. We'll run out of time. Okay, so I'm going to hide what we did before. Hide what we did before so that we don't have clutter on the screen. So I'm going to zoom a little bit. Okay. So this is year 0, 1, 2, 3. So from the question, Discovery paid a dividend of 6 rand last year. So we put our 6 rand here. Okay, may I have your attention? Okay, let's go together so that we can make a mistake together. And we have to find someone to blame. Who are we going to blame when we find the wrong answer? Obviously, it's not me. It's not fashionable to blame yourself. Okay. So 6 rand. Okay, let's put a line there and then say growth. We are fixing the spreadsheet as we grow. So 6 rand is our dividend in year 0. Okay, so then we go, is dividend are expected to grow at 25% in year 1. So here we put our 25% in year 1. In year 2, you can see here is 18%. 18%. In year 3, 12%. 12%. Then from year 4, the growth rate is expected to drop to 10%. So 10% is your long-term growth, 10%. Per annum indefinitely. If the investor's required return is 19%, then we put our 19% here as our required return. What is the intrinsic value of the share? Okay. So now what's left is just plug and play. So we are going to grow this dividend. Okay, maybe to make people happier if we do that. Put more zeros. Maybe, who knows what makes people happy. So we're going to grow 6%, this 6 rand by 1 plus by 25% in the first year. Then we grow the 7 rand 50 by 1 plus 18% for the following year. We grow the 8 rand 85 by, if I make a mistake, whose fault? It's going to be, whose fault is it? Letabo's fault. At least we found someone to blame. We can't just do without. So that's year 3. Year 4 onwards, we are going to say equals to 1 plus. Remember, I'm just growing by 1. Oh, what happened? It's not yet Letabo. This is my fault. No, not yet Letabo's fault. 1 plus 10%. Oh, yeah, there's no times. There, what was working fine. Okay, so we found all our numbers. So now we want to find the future price here. First thing. So the future price here we go to, so we know using our dividend constant growth model or Gordon's model, we know that our future price is, I will skip that. I won't do the shortcut. Some of you are already seeing there's a shortcut to be done, but I won't do the shortcut. So we'll put the future year 3 price somewhere there so that we have space. Year 3 price is equals to, remember, D1, which is the future dividend. Our future dividend from the constant period is equals to that divided by required return. Required return we know is that one minus constant growth thing is that the 121. Pilile, perfect. You are perfect. If no one ever told you you are perfect, tell them they don't know what they are doing. Okay, now we are getting close to the answer. I can almost touch the answer. But the only thing which is standing between me and the answer is a small thing called present values. Present values, ladies and gentlemen, easy peasy like a lemon squeeze. Okay, forgive me. I have a 17-year-old, so I need to be like a modern. Oh, also I'm young. I'm a 27-year-old. Sorry. I'm forgetting that. Divided by required rate of return. This is to the power of 1. So to the power of 1, nothing happens. Then we go to the next year, dividend 2 divided by open bracket 1 plus, because we are finding, okay, to the power of 2, because it's year number 2. Ladies and gentlemen, this year number 2 equals to that divided by, okay, ladies and gentlemen, but they'll say the accent is the one which is disturbing people, plus required return to the power of what? To the power of 3, because it's year number 3. Okay, the accent is perfect. Equals to the price, ladies and gentlemen, divided by 1 plus, okay, 19% to the power of what? The accent is correct. 3, because it's the 3rd year price. There we go. This is where the time to phone your mother. Okay, if your mother is like my mother, don't phone me. My mother will say, I don't care. Did you send me money? I said, no, mommy. I did something so great. Like finding the correct answer. Okay. If it's my mother, I will say, did you get the degree? Not yet. I'm working on it. Okay. So phone me when you have it. 1932. Abby, very close. Very close. Anything which is unclear, ladies and gentlemen. Anything unclear. Anything unclear.
Can we have a look at the formula for year 1 present value?
This one. M3, if you double click it, it tells us it's M3 divided by 1 plus the required rate of return.
Fantastic, thanks.
Okay. Any questions, ladies and gentlemen? Nothing. Lebeko, I don't know how you got there. Looks like people are happy. Can we move? Okay, we are going to move on. Okay. My answer there is all messed up. I don't know what I was doing. No, that's not my answer. My answer is 9032. I don't know. My answer there was messed up. Ladies and gentlemen, we are going to take a commercial break by doing multiple choice. Life is good. Life is good. This is the commercial break to just rest our brains a little bit. Which of the following statements is true? There's a pop-up which will come. I'm going to do what I did last week. Last week, I shared this. I will share the slides. I'll put them on my UNISA. I'm going to send them on email, blah, 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 blah. I'm going to do the recording, the video on there again. Remember, this long lecture, it's also contained in bite sizes on my UNISA. But you are here, you can go and watch the full version or bite-sized. The bite-sized video, the 5-minute video. I think it's not 5 minutes for this one. I think it probably should be close to like 7 minutes or so. The one which I did there. Then it was like, welcome to INV2601 in 5 minutes or less. That's what it was. That's what it will start like. Okay, ladies and gentlemen, let's do this one. Easy one. Your poll is empty. Okay, they're just posting the chat, ladies and gentlemen. My poll, I don't know why. See, those Nyamundas. I told you, these Nyamundas, I don't know what to do with them. Close, poll. I'm going to close it because it's not it says view. Okay, let's reopen the poll. I think it works. Yeah, somebody saw that it works. Thank you. Who saw that the poll works? Oh, Kaylin saw that it works. Thank you. Thank you, Kaylin. And then it pops up. There's a pop-up there. Okay. No. Sorry, the Nyamundas are right. They are not sending anything to bewitch me. Sorry, the Nyamundas. Yeah, this is not your time to bewitch me. IT bot. Oh, I think I don't know, Jonathan. The Hawthorns are bewitching your computer. Okay, but this time the Nyamundas hasn't done anything wrong. Sorry, Nyamundas. I'm accusing you of wrong things when you are doing fine. Okay, so it's 2 questions. So after the first one, then you click the arrow to go to the next one. Or you can just say number 1, A, number 2, be like Mesha, I just said 1, okay. Not like Lesecha says number 1B, 1B, 2B, something like that. Let's do that, ladies and gentlemen. Let's do that. So that we can make progress. We are looking at 16 minutes, which we want to make use of. Okay, let's see how many people have answered. Okay, let me say, I'll just put anything so that I can see. Let's see how many people have answered. 4 responses. Ladies and gentlemen, let's do 1A, 2B, 1A, 2B, so that we can make good use of the 15 minutes left. Ladies and gentlemen, the theory is going. Okay, let's move. Let's move to the next slide. So which of the following statements is true regarding fundamental analysis of stock valuation? B, it involves analyzing a company's financial statements, economic indicators to determine its intrinsic value. That's, I think, now chapter number 6 or study unit number 6, somewhere there. Which of the following ratios would be most useful for assessing company's liquidity? The current ratio. Liquidity is to say how easy is it to convert assets into cash. So the ratio there you are supposed to use is this current ratio. Ladies and gentlemen, theory is all done. Let's move on to this one. Probably most of you will be able to do. So I think this one will move fast. I hope this one will move fast. But if you are not sure, then I knew 2 is C, but I still gave a wrong answer. Lesecha. The Magongwas, go and ask them. I think they are disturbing you. Expected return, ladies and gentlemen, is to say what return. Okay, sorry, let's transition nicely. So we are going to talk about expected return. So ladies and gentlemen, now let's focus on expected return so that everyone can move. We can move with everyone. Expected. So when we say expected return, we're saying what is the return we're expecting in the future. That's all, future return. So in this module, we are more worried about future return as opposed to past return. So for example, what is the expected return of asset A? If we are told that the probability for a boom, say economy is 30%, normal is 0.5, recession is 0.2, and in a boom economy, our asset A is going to give us 15%. So we are doing this green part together. In a normal economy, our asset A is going to give us 10%. In a recession, our asset A is going to give us 2%. What is the expected return of A? We are going to simply say 0.3 times 15, which is that times that, plus 0.5 times 10, which is 0.5 times 10, plus 0.2 times 2, which is that, gives you 9.9. Ladies and gentlemen, if you are with me, you already know that your question is this one, B. And if you finish B, you can go and do C. So all you are doing is like this, 0.3 times 15, 0.5 times 10, 0.2 times 20, then you get 9.9. You do your thing here, then you get your answer. You do your thing here, and you get your answer. Let's do that quickly. Let's do that quickly. Let's do that quickly and post in the chat. Let's post in the chat. So we are doing what is the expected return for B and what is the expected return for C. 12 minutes, ladies and gentlemen, left. So let's move. We are only left with 12 minutes to just apply, and then we are home and dry. Okay, Kyle has already claimed the number there. Let's go, let's go, let's go. This one is easy. Easy, ladies and gentlemen. This one is easy and fast. But if you are a little bit confused, you can ask me. Not confused, a little bit unsure. Let's go, let's go, let's go. This one is easy. This one is easy. This one is easy, ladies and gentlemen. If you're unsure, you can ask in the chat. Let's go, let's go, let's go, let's go, let's go. The time is not waiting for us. I think there was someone who said a nice Zulu saying for the time is running away. They say, oh, I think they said, isikhathi sidliwe inja. I think that was the good Zulu there, which I got. Isikhathi sidliwe inja. Okay? So the dog, okay, so the literal translation is to say the time has been eaten by a dog. So that's where we are, ladies and gentlemen. The dog is doing the wrong things. Ladies and gentlemen, let's move. Okay? 11.7 and 9.7. Ladies and gentlemen, I can see I only have these perfect people. 11.7. Everyone got it. Do we need to do it together? I can see only perfect.
Please, no, let's move forward, please.
Yeah. Okay, let's keep the theory, yeah. Okay. Now let's talk about something called the standard deviation. Okay, I don't think I have to teach you the theory first, so that you understand when we are still. So standard deviation is a measure of risk. What does it measure? It's variability from expected outcomes. What am I? I'm not even saying anything which is meaningful. How unsure are we about the future? So are we very unsure that next year is going to be terrible, or we are a little bit unsure? So that variability from expected outcomes, that do you know where I blame for this word? It's my first lecturer in investments. He used exactly the same term, and I'm using it exactly the same. And I was so happy to hear it, but it doesn't mean much. To say, how unsure are we about the future? So how much outcomes might deviate from our expectation? Do we expect the next year to be so different from what we expect, or not so different? So the higher our unsureness, the higher the expected variability, the higher the risk. Okay. Don't worry. It's not even. So if we look, let's do this thing together. Okay. So let's say Sanlam has a current price of 66 Rand, and there's this thing called Delta Properties, also 66 Rand. So the first estimate we get is 72. The next estimate we get for Sanlam is 69. That's future share prices. 69. The next estimate we are getting is 63. Versus Delta Properties, first estimate for next year, 100. Next estimate, 40. Next estimate for third estimate is 64. So the question is, which share has a higher unsureness or higher variability from expected outcome? If we are told that our expected outcome, our average for all these is still 68 for both of them, which one? Let's put in the chat. Sanlam or Delta? Let's go, ladies and gentlemen. Time. Let's go.
Which one is more variable, or which one is safer?
Which one is more variable? Which one is more variable?
Okay.
Which one is more variable between the two? Which one is more variable? Okay, I think we are together. So Delta is more variable, which means it's a higher risk. That's all I'm trying to teach here. It's more variable from outcome. So if we look at this thing, if we look at these two lines, so if we look at these two lines, we can see that an asset which plots like the blue line is a lower risk than the asset which plots like a red line. Now let's do a question. I'm done with theory. I'm so done with theory. Okay. Now let's find the probability. Let's find the standard deviation of asset A. So we are going to do this asset A together, and we are going to do it in a very simple way. I don't know why I kept this. I don't know why I kept this. So this one, we are going to do it in a simple way, in the sense that the formula for standard deviation is this one at the top here. Square root summation R minus expected return squared times PI. So the first thing we want to do is to calculate expected return for asset A. That's the first step. We already did an expected return calculation, because remember we said 0.3 times 15, which is that times that, plus 0.5 times 10, which is that times that, plus 0.2 times 2, which is that times that, which gave us 9.9. Now the question is, what is the standard deviation for A? The standard deviation, don't worry about this. This table is confusing. Let's go here. This one is easier. If we look nicely, not carefully, nicely. Okay, don't look carefully. If you look carefully, I don't know, you're going to make a mistake. Nicely, if you look nicely at the formula here, because now we already have an expected return, we can actually do something. So we do this. We say open bracket 15, which is this one, minus expected return, which is this one. We close bracket squared times 0.3. So we are doing what's here per line. Then we go to the next line, which is normal. We say 10, which is this one, minus 9.9, close bracket squared times this probability 0.5. This is what we have. Then we say 2, which is this one, expected, this the return, the third return in the recession, minus expected return, which is, well, just repeating this formula over and over again, squared times P, which is 0.2. If we do that, we'll get 20.09. But if we look nicely at our formula, it has a square root outside here. So we then say the square root of 20.09 is equals to 4.5. Square root of 20.09 is equals to 4.5. To find what we call the coefficient of variation, we are going to say our standard deviation 4.5 divided by expected return gives us 0.4545. Okay. I will go over it nicely, okay, but very quickly. Okay, we are using this formula. So we see, if you look at this formula carefully, okay, now this time it's careful, not nicely anymore. Carefully, we see that we need this factor called expected return first. So we calculate our expected return. We already know, most of you got it right there. Expected return is equals to probability times that. So it's 0.3 times 15, which is what we have here. 0.3 times 15, 0.5 times there, 0.2 times 2, which gives us 9.9. So now we just go back to our formula and do per line. So we're going to say 15, which is that, minus 9.9, which is expected return, squared, remember to square, times 0.3, which is the probability. Then you put your answer down. 10, which is that, minus 9.9 expected return, squared times 0.5, which is that, plus 2 minus 9.9, which is expected. 2 is this one, minus times 0.2, which is there, equals 20.2. This should be easy, ladies and gentlemen. You add everything up. So we add what we found up, and it gives you 20.9. Then we say square root, because our formula is a square root there, which gives 4.5. To find the coefficient, so standard deviation, we got coefficient of variation 4.5 divided by expected return, 2, which is this formula. Okay. So yours is this one, B, do B. And if you are fast enough, do C. So when you do that, so this is what we did together, this one at the bottom. Don't worry, this is exactly what we're doing together. So we are going to do B, but use your probability is that, and your asset return is that. If you have a question, put in the chat. If you are good, right? The funny signs are the problem. Chantel, once you master it, you will appreciate the funny signs. Because now when you are talking to other people, when you illustrate on the board to your subordinates, you are not just going to say expected return. You are just write ER. The standard deviation, you are not going to say standard. Who's writes that? I have a degree, man. You put a sigma, which is that thing. Ladies and gentlemen, we need to come across the sophisticated, the more we get educated. Okay, it's not my stuff. It's not my stuff. But you can't say I'm showing off. You need to write on the whiteboard, you stand up there and you put a sigma and you carry on with your life. People say, wow, Chantel knows their stuff. And you get a promotion. Nothing wrong with that. But if you come across as a politician, we using big words, that's not good. I was so flabbergasted. Everyone is put off. Politician. Okay. Ladies and gentlemen, if you are unsure, let's say, when you find your expected return, ladies and gentlemen, for B, please post it in the chat. Hey, ladies and gentlemen, I can see time has run away. Time has run away from us. Let's look at the answer. Expected return, 17.7. Ellen, well done. Lebohang, well done. Wow, very clever people. Lebohang, you got everything right. I'm getting jealous. Lesecha. Lesecha got it right. Kyle. Guys, you are so brilliant. The table, I don't know why you have multiplied the final answer by 100. I don't know why you did that. Kyle, you fixed your thing. There's 13.7. Let's do together so that we. Okay, ladies and gentlemen, so the 8 goes expected return 0.3 times 25, which is this one. 0.5 times 20, 0.2 times 1 gives you 17.7. Then you hold your head, you hold your no shaking hand allowed, okay? You go first line, 25 minus 17.7 expected return square times 30 plus 20 minus expected return 17.7 squared times 0.5, which is that one. Then you go to the third line. 1 minus 17.7 squared times 0.2, you get 74.42. The square root of that, 74.42, 8.63. 8.63 divided by 17.7, 0.4876. I will stop the recording and I'll ask for questions. Let me stop the recording, otherwise I'll forget to stop the recording. Any questions? Kyle?
So I've got a message in the